We're Compound Everything, and we talk money, markets, and investing. And this week we are talking about a super investor, I guess you could call him, Walter Schloss, who has long passed away, but he was an excellent investor. I think he invested something like 15 point something percent annualized over 4.5 decades.
Yeah, 15.3 I think is
15.3
versus 10% for the S&P 500
at that same
at the same duration,
yes.
which is pretty good.
Yes.
He's some people have called him one of the best to ever play the game. So I thought, okay, interesting. Let's look into him.
Yeah.
That's one of our favorite things to do, right? Is to look into investors, into their philosophies and whatnot. And I think we've learned a lot from Walter Schloss.
Yes, we have. And we've learned a lot from a lot of investors. We like to copycat. I know Manesh Pabrai says he's a shameless copycat, and I would echo that.
Yeah.
That idea that we are shameless copycats. And some of these older investors who are no longer with us are some of the best teachers out there.
Yeah. Well, and the funny thing, just going back to your comment on copycats, we like to copy investors and look at their positions and dissect their positions and sometimes take a position based on their positions. And interestingly, that's not new. In studying Walter Schloss, you can see that, funny enough, there were people that copycat Ben Graham. And there's a lot of people that copycatted Ben Graham and made a lot of money doing it. And so initially, I think Buffett was kind of cloning Ben Graham to a point until he went and branched out on his own. So copycatting and cloning is not a new concept.
It's not a new concept. Yeah. And we can no longer copycat, obviously, if someone's not alive. No. They are not making trades from the
He passed away about 10, 12 years ago.
Yes. Yeah. But what we can do is copy their investment philosophies and style, or at least pick and choose what we like about them. Yes.
So what did we learn about Walter Schloss? Should we go back and do a little bit of a bio on him? Okay.
Yes.
A little bit of background on Walter Schloss. So Walter Schloss was born in 1916, and he lived to the age of 95 and ran his investment company. Walter Schloss was born in 1916 and lived to the age of 95. And he operated his investment company with his son for a good portion of it for 45 years, which is pretty good. And if you've compounded at 15.3% for 45 years, you've done pretty well for yourself.
And it is interesting, at that same time frame, Buffett was compounding, and he did better.
And
we'll get to that.
And they had a very different investing style and philosophy.
And we can cover that later on, but it's just an interesting note.
And so just to give you some kind of idea as to how much that is, if you gave Walter Schloss $10,000 at the beginning of his career, and he compounded that at 15.3% annualized for you, you'd have, at the end, cashed out at about just under $16 million. So he would have turned $10,000 into $16 million.
In 45 years.
In 45 years. Not a bad return.
No, not a bad return.
And so one thing to know about Walter Schloss is he actually had no formal business degree. He did not have a Bachelor of Commerce degree, did not have an MBA. And in fact, he started on just as a stock runner in the stock exchanges. And he ended up taking night courses with, guess who? Ben Graham. And so that's how his formal education went. And he worked for Graham Newman for about 9 years before starting his own investment firm in around 1956.
Yeah. And that caught my attention about the high school education. And Francis Chu also. I'm pretty sure he also had nothing more than a high school education when he started. He does now, but when he started. And many of the super investors that we follow don't have a finance education.
Yeah.
They have more than a high school education, but they're in engineering or historians.
Yes.
Yeah, but they're not necessarily educated in finance.
That's right. I mean, I'm sure it doesn't hurt, but at the same time, it's not like it's a requirement. It's kind of what I've been learning.
But it's encouraging as we also don't have a education in finance.
Right.
So it's encouraging that some of these great and successful investors also don't have an education.
And they learned along the way.
Yes.
And that's what we're trying to do.
And a lot of them added a finance portion of education after they were in the game.
That's right.
Which tends to be the route that we're also going.
That's right. Precisely. So he started his investment company. I think I said 56, but it was actually 1955 that he started it. And he was known to be very frugal. So
also a common thread.
That's right.
In value investors.
Yes,
value investors are frugal.
Yeah. So he operated out of a single office. Apparently, him and his son shared a telephone. And there's legend that he started with one filing cabinet, and it grew fold to 4 filing cabinets by the time they wrapped up the business. So he pretty much had a small office on a corner office somewhere that he ran with his son, operating one telephone and 4 filing cabinets. He was a bare bones guy.
I think Shelby was too. Shelby Davis?
Yeah.
He was a very bare bones, very frugal. He'd wear his shoes until they were falling
Until they
apart.
wore out and whatnot. And so that's a common thread in the value investing community.
It's probably why Buffett says value investing is one of those things that works like a vaccine. Yeah, right? It either takes or it doesn't.
Right. You either get it or you don't.
You get it or you don't. And I think it's because you almost have to be that personality. You have to have that frugal personality to really appreciate value investing.
Yeah.
And if you don't have that personality, it just doesn't even resonate with you.
It doesn't take. Well, here's the other thing I liked about Walter Schloss and reading about him. He actually had only a very small number of investors. I can't remember the exact numbers. It was under 100 for sure. I think he had something like in the realm of like 50 or 60. And oftentimes they were smaller investors that he would actually look after in his partnership because he just wanted to help the little guy make some money.
Right.
And I really admired that about Walter Schloss.
So he was an investor for the people.
Yeah, I got that sense.
Good.
You know, like it was interesting.
So we've done a little bit of background. So why don't we do his investing style?
Yep.
And in studying him, I noticed he was very methodical. He was very, he had rules.
Yes.
And he didn't deviate from these rules.
Yeah.
And the most important thing to him was working capital.
Right.
That was his go-to metric. And he didn't appreciate earnings. He didn't love earnings.
Yeah.
He did not love management, but he loved working capital. And he essentially liked to buy a $10 bill for $4.
Yeah. Well, and I think that was his margin of safety. That was his safety net. If he could find something that was trading below or at 2/3 of working capital, he was a happy camper.
And one of the reasons that worked for him is because of the era in which he invested.
Yes.
Working capital doesn't work quite the same, from what I have found, as it did at that time when there was just more industrials and those were the bigger companies and whatnot.
Yeah. He one of the things he said is he likes to take a company as it is now, not as he speculates it will be in the future.
Because no one knows the future.
Right. So here's a quote by Walter Schloss on earnings, which I thought is very telling, and it kind of summarizes his investing style quite well. He says, "I really have nothing against earnings, except that, in the first place, earnings have a way of changing. Secondly, your earnings projections may be right, but people's idea of the multiple has changed. So I find it more comfortable and satisfying to look at book value. Earnings are more likely to fluctuate than book values, and therefore estimating long-term earnings than, say, next year's or so can be subject to serious error." So interestingly, we've done a little talk on Shelby Davis. And one of Shelby Davis's favorite things to do is to find what he called a double play.
And we love the double play.
And we love the double play
It was interesting to us when we found that quote because we were like, oh, we actually really, really love what Shelby called the Davis double play.
Yes, that's right. So what is the Davis double play?
Okay, so the Davis double play would be when you have a company and it's growing and they are growing their earnings. And of course that leads to investors wanting to invest more, therefore pushing the multiple up, and then the company continues to grow and the earnings are growing. Then of course the multiple gets higher because more investor comes in, more investors come in, and then that is the Davis double play because not only are you getting a return because the company's growing, you're getting a higher return because the multiple is growing.
That's
and that can add to humongous gains in the portfolio. And we have seen that in a few of our decisions, our own holdings, where we kind of knew the company was good and it was growing. And so we were willing to invest because we're like, oh, this company knows how to grow. They know how to allocate capital, which of course is very important for a CEO to know how to do that. And then we had the benefit of, it's kind of like icing on the cake when the other investors start coming in, they're like pushing this multiple up higher and higher.
Well, think about it. One of the right now the largest stock in the world, or I don't know if it's been overpassed, but Apple is an example of that.
Maybe Microsoft, I think.
Well, and Microsoft,
it's one of the
one of the two.
Yeah.
But Apple is an example of that. So back in 2016, it was trading at a PE multiple of like something like 12 or something like that. I can't remember exactly. As low as it got, but in the low double digits. And their earnings started to appreciate, and of course Warren Buffett started buying in, etc. Well, and guess what? Now investors are paying a price earnings multiple somewhere in the realm of 30.
Yeah.
So that's kind of how it works out. And from that time, it's appreciated, I think, at least fivefold.
Yeah. Meta's a more recent example.
Meta's a more recent example. So again, earnings are appreciating, and now investors, even as of maybe a year and a half ago, were paying PE or bidding PE multiples of 12, maybe 15, and now it's up to 30 again. So at that point, you've made quite a bit of money.
Right. So, but Walter Schloss did not care about earnings.
He did not.
And he actually thought what we're talking about was like almost like witchcraft.
Right. Well, he would say he didn't agree with it, and other people can do it. He admired Warren Buffett for being able to do it, but it wasn't for him.
It was predicting the future he didn't like. 'Cause
Yeah.
He brought that up a few times. He's like, you do not know what the future holds, and if you're looking at projected earnings, you don't know.
Yeah.
You don't know what a day brings forth.
Right. Exactly. Biblical concept. So for him, he would like to say something along the lines of, "I'd like to buy the company as it is now, not as it's going to be in a few years." And that was his kind of margin of safety. One of the things, if you ever listen to an interview with him or read an interview with him, he says repeatedly, he's like, "I don't like to lose money."
I mean, who does?
Who does? But at the same point, for him, it's the typical value investing adage that take care of your downside and the upside will take care of itself. If you buy a stock cheap enough and with a good margin of safety, usually good things will happen with it.
Or the bad isn't.
Or the bad is already priced in.
It's not going to blow your account up.
Yeah. So a recent example is actually a Twitter post I sent to you. X post. So I can't get over calling it Twitter. But I sent a recent X post to you that kind of exemplified that. There was apparently, I'm not sure the details behind this, but there was apparently some group who bought a baseball team. And they bought a baseball team knowing that the arena that they played in, or stadium, thank you, the stadium they played in, if it came down to it, they bought it at such a good price, they could literally melt down the metal in the stadium and recover all their money if the baseball team didn't make it.
Yeah, that's protecting your downside.
That's protecting your downside. Yeah. So that's the kind of deal that Walter Schloss would have been looking for.
That also would go along with his whole working capital thing.
That's right.
What do they have on the books that's actually worth something?
Right. They had to have tangible assets, and that's what
Very
he was interested
too.
in. And if he could buy it cheap enough, then it was a go. Now, he had criteria that he looked into. So he had a bit of a checklist. Now, he actually has, I think it was a 16-point checklist.
He does have a 16-point checklist, and you can find that online. It's very worth the read.
So if you Google Walter Schloss 16 points and whatnot, it's a PDF file. You'll come across it. It wasn't very hard. But
written on a typewriter.
Written on a typewriter with a few typos. It was very sweet, actually, yeah. So a few things that he'd look for, though, he had a checklist of a few things. And a few things that jumped out were really 5 points. So he used a checklist for an initial consideration as to whether he was going to buy a stock. And it looks to me like it consisted of 5 points. It had to have a good 10-year track record. It had to have little or no debt. He was very, very against debt. And if you listen to any interviews with him, he was very, very much against debt. And you can, I think, because of some of the things he had witnessed.
I was going to say, it was probably in part the era in which he grew up.
Yeah.
It molded him.
Yeah.
And it formed that anti-debt personality.
Yeah. Well, he even gave the example of someone who has inherited Geico shares. He ended up borrowing against them to fund these pet projects, I guess he had. And Geico's shares plummeted, and this guy went bankrupt and actually ended up committing suicide.
There's a lot of traders in particular who commit suicide, and a lot of the ones who commit suicide trade on margin.
Yeah, and so he's talking about corporate debt, and we're talking a little bit about personal debt and margin debt, but I think they're the same. So he would have been very against debt in all forms.
Yeah.
So the third point was a low price to book value ratio.
Yeah.
So again, he loved book value.
Loved it.
And so he would buy things that were trading, below book to protect his downside.
I feel like book value isn't it's not the same metric it once was. I guess it is if you're looking at the right sector and the right companies. But there's new sectors that have come out because of technology and whatnot where book value it's just not the best metric in which to value a company anymore, a tech company or other companies anymore.
Yeah, so you'd be looking at more kind of industrials and things like that, rails and whatnot that had kind of more of a hard book value. So whereas book value, I think maybe a little bit more fudge nowadays. And
we read a lot on value investors when we first started, and so we really did get caught up in the book value as well.
Yeah.
And we were looking for this low book value and whatnot. And what we didn't realize when we started was that is very sector dependent as to how much weight you want to put on that. And we missed out on some good opportunities because we got really hung up on book value in the wrong sectors.
Yeah. Well, think of Apple now. You would never, if you were a book value investor, you'd never buy Apple.
Never. Yeah.
I mean, there's some people who would say I wouldn't buy Apple at this price anyways.
Right.
But even if
Which
Apple,
would be us, we wouldn't buy.
No, we wouldn't. We probably wouldn't buy Apple at this price either.
Yeah.
But But let's say even if Apple dropped by half, the book value is still not attractive.
Yeah. And we'd be loading up. If Apple dropped in half today or tomorrow, we would be buying shares.
Right, with all else being the same in the business.
Yeah.
But the point being is book value, I think, has become less of a tangible item for investing at this point.
It's less of a tell.
It's less of a tell, yeah. Well, and we'll talk about this maybe a little later. He even himself changed his investing style a little bit in his later years. The fourth point is he liked to search for stocks trading at 52-week lows. That's kind of, I think, how he did one of his initial screens. He'd look through the Value Line manual. He had his Value Line subscription, and he would go through that and try and find stocks trading at or close to their 52-week lows.
Yeah, and I like that because I do that.
Oh, I do too.
And the reason I do that is because I don't know if it was Lee Lu or Manesh Prabhai, but somebody said, like, how do you find your stocks? He's like, well, I start with the 52-week low list. I don't remember
I think that was Manish.
Was it? Okay.
Yeah, I'm pretty sure.
And I was like, that is a good idea. Like, why not just start there? Most of them are crap. Most of them are their 52-week lows for a reason.
That's right.
But once in a while, you find...
It's like surfing through the discount bin.
Yeah, you're
Sometimes
wow,
you find something really good there.
I'm going to look into this, and then, lo and behold, it's a good value company.
That's right.
Yeah.
That's right. And the fifth point is it had to have high insider ownership. So he liked companies that had a lot of insiders that held a rather large position because he knew they'd operate in their own self-interest. If you're a large shareholder, there's a good chance you're not going to screw over the shareholders for the most part.
It's hard to find really great companies with high inside ownership now.
It actually is. It actually is hard to find.
Micro caps and mid caps, I find you can...
There's a little bit more of that,
but with those really large companies, the inside ownership starts to get harder to find.
Yeah, I'm not sure why that is.
Yeah, and even recently, I mean, Jeff Bezos has been dumping shares.
Yeah, Mark Zuckerberg's been dumping shares.
So that, of course, makes the inside ownership less. And Mark Zuckerberg and Bezos as well, and a few other big CEOs were dumping shares back in 2021, I think it was. And it's not like they ever buy back.
No. Well, and the problem is
why would they? They have so many shares.
Yeah, well, and they also get share-based compensation. Like Mark Zuckerberg, he sells a bunch of shares. Well, he'll probably just get more.
Yeah, so it's just a little different now with that. And I know maybe it was like that then too, and that's why it made it on
Well, maybe
list.
you're onto something there with the market cap. I think you might be very much onto something with the market cap.
Right.
These mega cap stocks and whatnot, finding companies with high insider ownership gets tough. I mean, but if you start looking into like the small to mid cap space, you may find insiders, specifically maybe founders and things like that, or founding families who have 50% ownership or things like that. So
and they are out there, the mid and smaller.
They are out there. If you find a bargain there, you'd at least hope the major insider shareholders their interests will be aligned with yours.
Right. One thing about insider ownership, well, actually, just to circle back to the mega caps, they don't do inside buying; they do share buybacks.
That's right. Yeah, that's true. That's true.
That's a mega cap play there. One thing about insider ownership, though, that we have found you have to be careful is sometimes when a company is getting some bad press, which will lead to a depressed price, which leads to more bad press, and on and on. Once in a while, CEOs and CFOs will, in fact, buy shares. And we have noticed that when you look at the amount they buy, it seems like a lot, but when you look at their whole compensation, it's not really a lot of their net worth.
Right.
And then we found it actually doesn't matter because it almost seems like it's more of a publicity, like, oh, it's okay, like I'm buying shares, but it doesn't necessarily mean the company is okay.
Right, because that gets recorded.
Right.
There's people who track that.
Right, and they're good salespeople. That's what we say. CEOs are salespeople.
That's right. That leads me to a point. So we went through the 5 points, the initial screeners that Walter Schloss looks for. But one of the things that he didn't do, he's passed away. But one thing he was not a fan of is actually going and meeting management.
No, he did not like that.
He did not like meeting management. And part of the reason for that is because he didn't want to be influenced by them. And so he was a guy who liked to look at the hard numbers. And he thought that if I talk to management, they may be likable people and it might influence the way he thinks.
He said if he met them, he would most likely have a bias towards the company.
Yeah.
Because he said they were probably decent people and they're trying to sell their company.
They're trying.
And so
it's
it
their
would
job.
Cloud his judgment as to whether or not the company was actually good. And I think it's Peter Lynch who also says that. Don't quote me on but there's another, very wealthy investor who says meeting management really they are able to sell you on their company.
Yeah, well, and if you think about a CEO, there's a reason they got to that position. The reason they got to that position is because either A, they were good salespeople and they prospered the company, or B, or both, they were able to sell themselves.
Yeah.
And so there's a reason they're in that C-suite.
Yeah.
And
almost every very successful person is a good salesperson.
Yeah.
They sell something.
They sell something. Yeah. So in this scenario, CEOs are often very good salespeople, and he didn't want to be affected by that. And in fact, so much so that he wouldn't even attend, and this also maybe boils down to his frugality, but he would not even attend a shareholders meeting unless it was within a 20-mile radius of his of his place.
I mean, he might have valued his time too. He might have just been like,
perhaps,
what, it's just not worth my time. I don't love meeting the management in the first
Although,
place.
the funny part is, actually, he first met Warren Buffett at a shareholders meeting.
Oh, okay.
In the 1950s. So, I mean, you could say maybe he was doing himself a disservice because he wasn't networking and whatnot. But either way, he didn't like to go to shareholders meetings if they were too far away.
And he really did have a mistrust of people in the companies. There's a quote I read by him. I won't quote it directly, but he essentially said, you find a stock and it's $50 and they say they're going to merge and they're going to pay you $80. But then their stock tanks and the merger doesn't happen and now it's down to $30. And they said and this is what he says, they say they're going to do something and then they don't.
They don't do it. Yes.
Right. And sometimes, and so that's just a whole, that was just on management. Like they said they were going to do this, but then they didn't. And we have found sometimes management says they're going to do something and then outside sources cause it not to happen. Because recently we were really burnt on iRobot.
Yes. So iRobot, for those of you who might not know, iRobot's a robotic vacuum cleaner company. And they had received a offer to purchase or negotiated offer to purchase. I don't know who initiated it, but there was an offer to purchase from Amazon for something around the realm of $60 per share. And so that was maybe a couple of years back. And so the stock, of course, immediately jumps. So that caused the share price to appreciate to within 5 or 6% of the purchase price with the expectation they'd be bought out by Amazon. But then a couple other things happened and iRobot, I guess, got into some operating troubles, had to borrow some money. So Amazon revised their purchase price down, which already is an exemplification of that.
They said they were going to do
They said they were going to do one thing. We're going to buy you out at $60. Now we're going to buy you out at $50 because you borrowed some money.
And we lost money on that.
So while this whole thing is going on, the antitrust people get involved. So the FTC and the EU, they start looking at it going, oh, well, there might be not enough competition for robotic vacuum cleaners out here. And I'm like, well, who cares about robotic vacuum cleaners?
And there are.
But apparently they do.
There are so many different robotic vacuum cleaners. But the FTC, they don't know.
So we ended up buying a little bit more.
We bought more.
We bought more shares.
So we're burnt once. Yeah. Shame on them.
Yeah. And then we bought more. So we're burnt twice. Shame on us. Right? But and then, of course, what ends up happening is the EU disallows, and of course, what happens? Amazon walks away.
Yeah. So again, they said they were going to do one thing.
Yeah.
It didn't happen, or it didn't happen the way they said because they lowered their price because of the new debt that iRobot came. So that was already one thing they changed. And then they said they were going to do something, and it didn't happen, and that was because it was out of their control with the FTC and the EU and all the watchdogs. Yeah. And like I said, we lost money on that.
Yeah. And I mean, that is part of business, and thankfully it was only a very small position. Yes. But at the same token, you get burned by management saying they're going to do something and don't. And that was on the Amazon side, a lot of it. Yeah. And the funny thing is, part of it was in their control, I would argue, with the FTC, because they could have made some concessions.
Right, but I just don't think it was worth it for Amazon.
I don't think they wanted to. I think they just kind of decided, we don't really care about this deal anymore. We're just going to walk away. Save face.
And Walter Schloss would have said, well, that's why. He said that would be exactly why I don't trust management. Because they say they're going to do one thing. And then they don't.
They do something else,
Whereas Warren Buffett loves he calls them workouts. And workouts are essentially things that need to be worked out. Yeah. Merger, arb, and that kind of stuff. And he really likes those types of plays. Yeah. So,
and we've done a number of those in the past, and they've worked out.
Yeah, we
this one didn't work out
Activision and Microsoft, we had money.
Thomson Reuters,
we did. That one worked out. Yeah. SodaStream and Pepsi. I actually think SodaStream and Pepsi might have been our very first merger arb.
It was actually. Play. Yeah, that one worked out fairly well. That was several years ago.
Nice. Yeah. But iRobot just has really soured me on them because I just feel like the watchdogs and the FTC, they're starting to get a little too involved.
Yeah.
Especially with the tech. It's like if they hear Meta, Amazon, Apple, Microsoft, they're just like, woo, they pounce.
Yeah.
Right? So maybe it would have worked out better if it was like Shark Ninja buying iRobot.
Something.
Maybe they would have just not even cared.
They wouldn't have batted an eye.
I mean, pharma does this kind of stuff all the time.
Oh,
and
all
no
the
one
time.
seems to care. So.
Yeah, that's right. So again, taking a lesson from Walter Schloss, he would have said, well, don't trust management.
Don't trust management.
So
I think we're going to wrap up there because we have quite a bit more to say about Walter Schloss. So why don't we summarize his 5 points?
So what are the 5 things you look for? First is a good 10-year track record. Second is no long-term debt or very little long-term debt. Third is a low price to book value ratio.
Yeah.
Fourth is high in-solar ownership. And fifth is a price trading at or close to his 52-week low. Yeah.
So that's a good place to wrap up.
I think so.
And we'll pick up on Walter Schloss again next week to cover more lessons that we have learned from him. If you could like and subscribe this video, that's really great. And we will see you next week.